NIO is on the move, facing both opportunities and challenges in the dynamic electric vehicle market. The Chinese EV giant recently announced a 10% reduction in its workforce, reflecting the company's proactive approach to enhance operational efficiency. Amidst this, Deutsche Bank provides a crucial perspective, emphasizing the need for strategic management of cash burn to navigate the complexities of the industry. How will NIO's decisions shape its future in the competitive electric vehicle space?
Yeah, look, there is a lot of competition out there, and even some of the bigger players like BYD, they're the biggest market player, and still yet, from October to November, their sales were ultimately flat, and they had to do a lot of cost cutting.
Just like other companies, NIO's decision to make significant workforce adjustments has been notable. The recent announcement of a 10% reduction in their workforce is a strategic move aimed at enhancing operational efficiency. This move has sparked discussions about the possibility of additional layoffs, reflecting the company's commitment to aligning its cost structure effectively. Deutsche Bank offers valuable insights into this matter, emphasizing the importance of strategic cost management. By echoing these sentiments, analyst Edison Yu provides concrete suggestions for streamlining efforts, underlining the need for NIO to navigate its operational landscape with a focus on long-term sustainability. Zooming in on this strategic move, NIO is contemplating the proposal to spin off its battery manufacturing unit. This potential spin-off extends beyond batteries, as there's also consideration for separating the chip development team from NIO's core operations. The financial implications of this move are substantial, with estimated savings reaching around 1.5 billion renminbi or $200,000, a figure that underscores the magnitude of the cost-effectiveness NIO aims to achieve. Deutsche Bank provides a rationale for the spin-off strategy. According to the bank, this move makes strategic sense, especially considering the robust local supply chain for batteries in China. By spinning off the battery manufacturing unit, NIO can tap into a competitive local market with cell suppliers vying for market share, naturally driving down costs. This aligns with NIO's objective to enhance efficiency and bolster its financial position. The consideration of spinning off the chip development team is also a strategic maneuver. With approximately 500 people, or 800 if all smart hardware efforts are included, and an annual R&D spend ranging from 500 million to 1 billion renminbi, NIO aims to position itself for sustained success. Analyst Edison Yu suggests that this division, which might hold minimal value add to NIO's brand, could find better traction as an independent entity.
So what they're trying with this battery swapping is this really novel solution to this road anxiety issue, which is the idea that you could drive your vehicle up to a station, and instead of filling it with gas or sitting there for it to charge, you have the battery swapped out in 5 or 10 minutes and have a new battery put in. It's a different model. It's a very capital-intensive model.
Now, NIO is famous for its strategic moves, and one such maneuver involves opening up its battery swap network to forge partnerships with key players in the electric vehicle industry. This move isn't just theoretical, it's actively collaborating with industry giants like Geely and Changan, signaling a concerted effort to strengthen its market presence. The collaboration extends beyond mere partnerships. NIO is smartly sharing the capital expenditure burden with these companies. By doing so, it's not just about expanding the battery swap network, it's a savvy financial move. This shared capex model is a testament to NIO's commitment to financial prudence and efficiency in its operations. But it doesn't stop there. NIO envisions more than just a collaborative network. It sees a future where licensing fees become a substantial revenue stream. By strategically partnering with companies like Geely and Changan, NIO is setting the stage for potential licensing opportunities. The overarching goal here is clear, and it's enhancing operational efficiency through these strategic partnerships. By teaming up with established players, NIO positions itself to benefit from shared resources, diverse expertise, and a broader market reach. It's a win-win scenario, where NIO not only strengthens its competitive position but also contributes to the growth and evolution of the EV industry as a whole. And as part of NIO's efforts to fortify its market presence, the company is actively considering expanding its dealer network. This strategic move speaks volumes about its commitment to growth. This reported consideration isn't just about numbers, but a calculated decision with tangible benefits in terms of operational and capital expenditures. By growing its dealer network, NIO anticipates operational and capital advantages. This isn't mere speculation, it's grounded in a practical understanding of the industry. More dealers mean wider market coverage, reducing operating costs per unit and optimized capital expenditure. It's a financial maneuver that aligns with NIO's goal of achieving not just expansion but sustainable and cost-effective growth. The strategic importance of a widespread dealer network cannot be overstated. With increased dealerships, NIO ensures that its electric vehicles are more accessible to a broader audience, thus strengthening its foothold in the competitive EV market. This move carries implications beyond just operational efficiency. It directly influences NIO's market reach and growth trajectory. By strategically placing its dealerships, NIO is poised to tap into new demographics and markets, driving sales and brand visibility. But before we continue, we really want to thank you for watching this far. We've also witnessed the unveiling of the NIO smartphone back in September, prompting an evaluation of this venture within NIO's diverse portfolio. This smartphone unit operates on a low-cost model with an annual operational expenditure of 200 to 300 million RMB. This cost-efficient approach is grounded in practicality, aligning with NIO's commitment to financial judgment in its ventures. However, as Edison Yu, a reputable financial analyst, points out, there's a nuanced perspective on this smartphone unit. Despite its low-cost operation, Yu views it as a potential distraction. This raises pertinent questions about NIO's strategic focus and whether the smartphone venture aligns with the core objectives of the electric vehicle company. In light of this, Yu suggests an alternative approach, which is letting an original smartphone equipment manufacturer lead this operation. This recommendation isn't dismissing the smartphone venture. Instead, it's a strategic pivot. By leveraging the expertise of established smartphone OEMs, NIO can potentially enhance the viability and competitiveness of its smartphone unit. This aligns with the principle of focusing on core competencies and allowing specialists to lead in areas outside the core business. But how did NIO's Q3 pan out on the delivery and financial fronts? There's a notable increase in the vehicle margin, a metric reflecting the profitability of each vehicle sold. Alongside this, there's a commendable surge in revenue growth, showcasing NIO's prowess in the electric vehicle market. However, it's not all smooth sailing. Challenges emerge as a drop in the total gross margin and substantial losses. The dip in the gross margin raises questions about the overall profitability of NIO's operations, while the substantial losses point to the hurdles faced by the company. Acknowledging these challenges, NIO is taking strategic steps to narrow its losses. Efforts are underway to ramp up production, with the acquisition of a production facility from JAC, a prominent manufacturer in China. This move is strategic, aiming to cut costs by around 10%. Despite substantial losses, NIO's balance sheet paints a somewhat reassuring picture, ending the last quarter with over $6.2 billion in cash and equivalents, constituting half of its total market capitalization. Now, Wall Street analysts have cast their sentiments on NIO, and the outlook is moderately optimistic, with a moderate buy rating prevailing. This signals a collective belief in the company's potential, but the devil is in the details of the one-year price targets, ranging from a cautious $8 to an ambitious $18.70. The diversity in these projections reflects the nuanced perspectives within the financial realm. Recent positive developments, such as NIO's inclusion on the list of approved car manufacturers in China, have played a pivotal role in shaping analysts' outlook. The news has injected a dose of optimism, triggering an upward move in NIO's stock price. This positive momentum has translated into a moderate by consensus rating, with analysts cautiously endorsing the potential for a 47.92% increase from the current price. However, Markets Insider takes a pragmatic stance, highlighting challenges that persist in NIO's journey. Persistent unprofitability and concerns about sales growth loom large, prompting questions about the effectiveness of NIO's ongoing turnaround efforts. The cautionary advice for investors centers on carefully acknowledging potential risks in the tumultuous electric vehicle market. While the outlook is tinged with optimism, it's crucial for investors to stay informed and conduct thorough research before making investment decisions. The financial landscape is dynamic and risks are inherent. So, do you think NIO will weather the storm and emerge stronger? Share your perspective in the comments below. And while you're at it, make sure to smash the like and subscribe buttons down below. Additionally, I highly recommend watching this fantastic video if you want to know more about NIO's battery swapping. Just click this video right here. Thank you for tuning in, and stay tuned for more exciting content in the future.